Hey guys, beauty. Welcome to our channel. You may have noticed how often we make emotional and irrational financial decisions, right? We buy superfluous things on impulse. We sell investments when downtown. We inherit bad family habits. Because today, we're going to dive into this fascinating universe of psychology behind our financial choices. I will explain the principles of behavioral finance and how our unconscious biases influence our investments and spending. In the end, you'll understand how to control these mind traps to make more assertive and rational choices with your money. So don't forget to subscribe to the channel to receive more valuable tips like this. Let's unravel the mysteries of behavioral finance together. Secure your spot and let's go. Behavioral finance is an interdisciplinary field that applies theories and methods from cognitive and social psychology to understand why people make the financial choices they do. It studies how our mental processes, feelings, and social relationships influence our invested decisions. 10 common biases. Cognitive lies. Cognitive views are systematic reasoning tendencies that can lead us to make non-optimal decisions. Some examples are the confirmation route, where we only seek information that confirms our beliefs, the status quo route, which makes us prefer the default option, and the anchoring route, where we get too attached to the first piece of information received. Understanding these things is key to making the best choices. Emotionality and money. Our emotions such as fear, hope, greed, and avarice directly interfere with how we handle money. For example, we are afraid of losing money, and this can lead us to act irrationally in times of financial market declines. Greed, on the other hand, can make people risk too much after high gains. Predisposition to risk. Each person has a different level of risk tolerance. Genetic factors and life experiences shape whether we are more or less exposed to risk. This must be taken into account when setting up an investment strategy. Losses versus gains experiments show that psychologically we feel more the pain of a loss than the joy of a gain of the same amount. This explains why we tend to hold assets that are not impaired at the expense of realizing gains. Endowment effect. We tend to value goods that we own more highly than equivalent goods that we don't own. This causes people to demand a higher price to give up something that has already been stolen compared to buying something new. Social influence. Our decisions are influenced by what we see friends, family, and influencers do. This can lead us to copy unsuccessful investments or believe in unrealistic promises of quick returns. Procrastination and lack of self-control. We often put off saving and investing, focusing only on the present. Our lack of self-control over impulses can compromise our finances in the long run. Illusion of control. I think we have more control and skill than we actually do. This causes people to take unnecessary risks, such as betting everything on an asset, thinking they can predict its behavior. Anchoring effect. The first information we receive about prices or returns anchors our perception, making it difficult to change our minds even when we receive new data. This could harm our investment judgments. Herd mentality. We tend to simply go with the flow of the market and the crowds. This causes us to get into overvalued investments just because everybody else is in. It facilitates the formation of speculative bubbles and irrational collective panics. Understanding these biases can help us make more rational and accurate financial decisions. We need to control our emotions and act with discipline, rationality, and objectivity when dealing with money. If you liked the video and want to learn more, subscribe to our channel. Get more tips on personal finance and how to achieve your financial freedom. To the next.